Massive turnaround in the Treasury market after that CPI report, the 10-year yield plunging by about 13 basis points. But Societe Generale won't rule out another near-term run toward 5%. Subadra Rajappa is the firm's head of U.S. rates strategy. Subadra, great to have you with us.
Thank you.
There are a lot of things in the pipe that could actually be inflationary, and it's not just policies. It's what's happening in California, too, right?
Yeah, because you look at the core PCE, a lot of that has to do with insurance costs. Car insurance, home insurance. So when insurance costs, when you have a catastrophe of this magnitude, you're going to see insurance costs, not just in California, but all over the country, go higher. So that's something that I'll be watching in the prints, both CPI as well as core PCE in the coming months. But, you know, this is a disaster of a very large magnitude. But, you know, the U.S. economy is still relatively large. You're looking at, you know, the impact in aggregate to the U.S. economy might actually be somewhat muted over the longer run. We might see a run-up in the unemployment rate for the next couple of months. Perhaps we could see some very specific sectors of the inflation basket go up. I mean, maybe lumber, construction costs, things like that might feed through to CPI. But for the most part, I think it's going to be something that's more temporary.
What if 5% 10-year, and thanks for joining us, by the way. What if 5% 10-year yields mean to the equity market? If anything, because this whole run-up, it's to a large extent been impervious.
Yeah, I think that a gradual increase in interest rates towards 5% is going to be okay. But if you start getting towards that 5% level, equity risk premiums start to get, unattractive. So investors are going to start looking at moving away from equities or risky assets, whether it be corporate bonds, and then starting to move their money towards more safer assets where you're getting a pretty good return of 5%. The question is that you're not looking for perhaps 10-year yields to go from 5% to 4% and getting that capital gain, but you could be there because the coupon or the returns look attractive. The rally in the bond market might ultimately turn out to be somewhat limited.
Subadra, how about, though, the implications of higher rates here around the world? And look, in the past, while our Fed may not be hawkish here, higher U.S. rates have been a disaster for certainly emerging economies. But we look at what's going on in Japan. Their bond market isn't necessarily getting, and we'll see how Japan trades tonight. But, I mean, ultimately, the JGB yields are something that I think are pulling up U.S. rates. Any thoughts on that?
Yeah, I think that they're going to be hiking rates. The Bank of Japan kind of skipped the December meeting, but they're poised to hike again, perhaps more than once this year. And the demand from Japanese accounts for treasuries or foreign accounts in general for treasuries has been quite low because domestic yields in Japan are quite attractive. So foreign demand has been going down. Custody holdings of treasuries from foreign central banks has been going down. And that has led to less demand for treasuries. So we've seen this buildup in term premium coming from less demand as well. So that's something that we're watching as well. You have more supply and less demand. So that's a recipe for a push towards 5%.
As you look at, Subadra, rates going up and down here, going up and down across the entire world, that's got to have a pretty significant impact on the dollar. As it has an impact on the dollar, what kind of impact then is that going to have on our economy and therefore the markets?
Yeah, the dollar has been strengthening quite dramatically. If you actually chart the 10-year yield and the dollar, you see that strong correlation. As the dollar has strengthened after the elections, you're seeing that that's been something that has been correlated with the rise in 10-year yields. The impact of the stronger dollar is going to be something that's felt not just in the U.S., but also in emerging countries. Latin America is going to feel the pressure of higher the strengthening of the dollar. And then we'll have to see what the impact of tariffs is going to be, if that's going to continue to strengthen the dollar. The last go around, the U.S. consumers really didn't feel tariffs feeding through because you had that offset from the stronger dollar. So that could very well, again, play out. But then the dollar is already very strong. Then you have to ask yourself how much more could it strengthen from here on?